I think any deviation from that would be a major shock to the market. So I think 25 basis points absolutely in the bag. But as you said earlier, the key is going to be really around the commentary that accompanies that. What will the Fed's outlook be? How are they absorbing the fact that some of the inbound data has been a little bit better than expected? So we've had this narrative of everything slowing down, manufacturing suffering. But actually, some of the numbers coming out of the US economy have been not too bad, particularly around households, for example, retail sales holding up. Is that going to put the Fed off course? I'm not sure. I think they will still continue on this easing path, and the market is pricing in a full 50 basis points for the rest of the year. I think that's absolutely reasonable to assume that that will go on.
Julie, for so long, the Fed was saying it was data dependent, but just like you pointed out, we actually have a lot of indicators that the data is pretty good as far as pointing to the strength of the economy. Yet, like you said, this rate cut is relatively priced in. So has the Fed changed its policy from less data dependent to more of an insurance play? And is that how we should be looking at this, at least going forward for the relative near term?
I think that's absolutely right, that there is much more forward-looking now and actually looking ahead to see what might happen to the US economy. You look at the trade war, that is having an effect on the US economy. It's not completely killing it. It's not throwing it into recession. The consumer is simply too strong for that to happen. But on the other hand, it is more likely that the economy will need support if this trade war is protracted. And I think the trade war will be protracted. If you look at the Democratic debate on the 16th of September, nobody was really coming out against tariffs, which I thought was absolutely extraordinary. Most of the US population actually is pro-trade. But actually, none of the Democratic candidates were really anti-tariff. And actually, Elizabeth Warren was starting to sound a bit like Donald Trump in terms of protectionism. So this could go on for a long, long time. And it suggests to me that the US economy is going to need support for an extended period.
And so if that is true, and if the trade war is protracted and it goes on for a period of time, is the United States market something that you think is still a good investment place for investors around the world or here in the United States to be putting their money? If we don't know what's going to happen with the trade war and there's so much uncertainty for corporate planning. Well,
I mean, we've been writing about this idea of Fortress America. So even though the United States political system is creating this trade conflict around the world and global export volumes are falling, the structure of the US economy lends itself to be the last man standing. 70% of the US economy is now services based, only 11% is manufacturing based. And you compare that with, say, Japan or Europe, and both of those regions are highly plugged into the global supply chain. America will be the relative winner in this war. It's got a bigger consumer sector. So even though America will perpetuate this whole issue, you're better off in US assets. Particularly S&P 500, although it has a big export sector within the S&P 500. But if you look at the growth in the S&P 500 and compare it with retail sales, US domestic retail sales, it's pretty much lockstep. So as long as the consumer is in good shape, I think the S&P 500 remains the best place to be while this trade war goes on.